While the retail market celebrates the recent price action around $76,000, a silent alarm is ringing across the institutional order books. We are currently witnessing a massive divergence between spot price momentum and the underlying liquidity required to sustain these levels. Most market participants are blindly looking at the green candles on the chart, assuming that the path to $100,000 is a straight line. The reality is that smart money has begun executing a distribution pattern that looks dangerously similar to the market structure we saw just before previous major corrections. If you are currently holding a significant portion of your net worth in Bitcoin, you are standing at a critical juncture that could define your portfolio performance for the next 4 years. You might be walking into a sophisticated bear trap designed to shake you out, or you might be buying the absolute top of the cycle before a multi-year winter leading into 2026. In the next few minutes, I am going to expose the specific on-chain metrics and macroeconomic signals that the mainstream media is ignoring. I will show you exactly what the whales are doing with their coins right now and why this $76,000 level is the most dangerous price point we have encountered in this entire cycle. There is a fundamental misunderstanding in the market right now regarding the nature of supply and demand at these all-time highs. When Bitcoin breaches a psychological barrier like $76,000, it naturally attracts a wave of late-stage retail investors who are driven purely by fear of missing out. However, let us get into the weeds of what is happening behind the scenes on the blockchain. The 30-day moving average for exchange inflows has just hit a level that we have not seen since the peak of the 2021 bull run. This metric is critical because it tells us that long-term holders are moving their assets from cold storage onto exchanges. They're not doing this to stake their coins or to earn yield. They are positioning themselves to sell into the liquidity provided by the new retail buyers entering the market. This transfer of wealth from strong hands to weak hands is the classic signal of a local top. Yet, there is a counter-argument that suggests this is merely a bear trap. A bear trap occurs when large players intentionally suppress the price or allow it to drop to trigger the stop-loss orders of over-leveraged long positions. We know that the open interest in the derivatives market has spiked by over 12% in the last week alone. This creates a highly fragile environment where a small drop in price could trigger a cascade of liquidations. If we see a sharp correction from $76,000 down to the low 60,000s, it would flush out the leverage and reset the market for a healthier move upward. This is the scenario that the bulls are banking on. They believe that the demand from the spot Bitcoin exchange traded funds is sufficient to absorb any selling pressure from long-term holders. The reality is that the inflows into these exchange-traded funds have started to decelerate over the last 14 trading days. We are no longer seeing the hundreds of millions of dollars in daily buying pressure that we saw earlier in the year. This deceleration matters because the market has priced in constant exponential demand. If that demand flatlines, the price of Bitcoin becomes vulnerable to gravity. Here's why this matters for your strategy going forward. You need to distinguish between a short-term correction and a cycle-ending event. If this data analysis is helping you clarify your position and stay ahead of the emotional crowd, feel free to join our inner circle by subscribing for more deep dives. Now, we must address the possibility that $76,000 is actually the cycle top that leads us into a bear market lasting until 2026. This is the scenario that nobody wants to talk about. But as a strategist, I must present the bearish case with equal weight. Historically, Bitcoin cycles have been dictated by the halving events. But the diminishing returns theory suggests that each cycle becomes less explosive than the last. If we look at the MVRV Z-score, which compares the market value to the realized value of Bitcoin, we are approaching the overvalued territory much faster than in previous cycles. In the past, once this metric crossed a score of 4, the market top was usually in within a matter of weeks. We are currently hovering just below that critical threshold. If we break above it without a significant consolidation period, we run the risk of a blow-off top. A blow-off top would mean a rapid spike to perhaps $85,000 or $90,000, followed by a brutal crash that marks the end of the bull run. This would leave investors holding bags for the next 2 years, waiting for the 2026 recovery. Furthermore, we cannot ignore the macroeconomic environment. Interest rates remain relatively high compared to the zero interest rate environment that fueled the previous bull runs. The global liquidity cycle is tightening, and central banks are hesitant to print money as aggressively as they did in the past. Without that flood of cheap capital, assets like Bitcoin struggle to maintain parabolic trajectories. This brings us back to the question of the bear trap versus the cycle top. The key differentiator will be the behavior of the miners. Miner capitulation has historically marked the bottom of bear markets, but miner profitability taking profit often marks the top. Right now, we are seeing public mining companies selling a portion of their holdings to fund operational expansion. This adds a consistent layer of sell pressure that the market must absorb every single day. If the price fails to hold above $76,000 and we start closing weekly candles below $70,000, the probability of a cycle top increases dramatically. On the other hand, if we can consolidate here for several weeks, allowing the moving averages to catch up, we could invalidate the bearish thesis. Consolidation is healthy. It represents the market agreeing on a new fair value. But vertical price action is rarely sustainable. Let us look at the leverage ratio across major offshore exchanges. The estimated leverage ratio is currently at an all-time high. This means that traders are borrowing more money than ever before to bet on the price of Bitcoin going up. When everyone is on the same side of the boat usually tips over. The market maker's job is to extract the maximum amount of pain from the maximum number of participants. Right now, the maximum pain scenario is a sharp drop that convinces everyone the bull market is over, followed by a slow grind back up. However, if that drop turns into a sustained downtrend, we are looking at the 2026 timeline. This timeline implies that we would enter a distribution phase that lasts for 12 to 18 months. During this phase, prices would slowly bleed out, frustrating both the bulls and the bears. It is a psychological game of attrition. If you are looking for actionable signals to navigate this uncertainty, consider turning on your notifications so you never miss an update when the metrics shift. So how do we determine if the cycle is extending into 2026 or ending now? We need to watch the dominance of Bitcoin relative to the rest of the cryptocurrency market. Typically, a cycle top for Bitcoin is followed by a rush of capital into smaller, riskier assets. We are starting to see early signs of this rotation, but it has not reached the mania phase yet. This suggests that Bitcoin might have one final leg up before the true cycle peak is established. The lack of a full-blown altcoin mania is perhaps the strongest argument against the idea that the cycle is already over. Usually, the top is marked by euphoria, where every random project is doing a tenfold return in a week. We are not there yet. The sentiment is optimistic, but it is not yet delusional. Therefore, my analysis leans towards $76,000 being a local top or a potential bear trap, rather than the absolute end of the cycle. However, the risk of a deep correction is higher today than it was when Bitcoin was at $50,000. The risk-to-reward ratio has shifted unfavorably for new entries. Smart money buys when there is blood in the streets, not when there is champagne on the table. Currently, there is a lot of champagne being passed around on social media. This is a contrarian signal that you should take seriously. If you are a long-term holder looking toward 2026, this volatility is just noise. But if you are a trader or someone looking to protect their capital in the medium term, you must tighten your risk management. Do not use excessive leverage at these levels. Do not assume that support levels will hold simply because they held in the past. The market structure has changed with the introduction of institutional products. Wall Street does not play by the same rules as the crypto natives. They are happy to short the market into oblivion if their models tell them the asset is overvalued. We are playing in a much bigger, more ruthless arena now. To summarize the playbook for the coming weeks, watch the weekly close carefully. If we close below $69,000, consider it a confirmed bear trap that has turned into a trend reversal. If we hold $76,000 and see open interest cool down, then the path to higher prices is clear. But do not blindly buy this level expecting an easy ride. The easy money has already been made. Now is the time for preservation and strategic positioning. The data suggests caution. And in this game, the cautious survivors are the ones who end up with the most Bitcoin in the end. Please remember that I am a strategist analyzing market data, and this is not personalized financial advice. You must do your own due diligence and consult with a certified financial professional before making any investment decisions. The markets are volatile, and capital is always at risk.